What's going on, everybody? Welcome back to my channel. In today's video, I am going to show you guys how to open and close credit spreads on Robinhood. Okay, this question comes up a lot from a lot of new traders that are just getting into options trading. So I thought I'd make a little educational video for you guys, showing y'all exactly how to do this on Robinhood. Okay, so we're going to use Amazon as an example. Nothing in this video is financial advice. It's all for informational purposes only. So do not copy any of these trades. These are just examples, okay? And most likely, I'm going to either make a profit or take a loss on these trades right now because I haven't researched Amazon for today's trading right now. And I'm using this just as an example. So I don't feel either way about Amazon. I just want to show you guys some executed trades. So, you learn. So yeah, I'm going to take the cost of a loss in case if it happens, just to be able to teach you guys. So please take a moment and click that like button, okay? I'd love it if we could just get 500 likes on this as soon as possible, okay? Now, let's do this. So Amazon. So say, for instance, you are bullish on Amazon. You think Amazon's going to go up. And this is where the credit spreads can get just a little confusing, okay? So make sure you watch till the end because I'm going to show you guys call credit spreads and put credit spreads, okay? And how to open and close them. I'm going to go through the entire process. So say you're going to go into the trade options, and here's how it's going to go down. Usually when you're bullish on a stock, you buy the calls. You buy calls because you're expecting prices to go up. But that's when you're paying money out, okay? That's when you're actually doing a debit. When you're getting a credit, when you're getting paid premium, it's the opposite. You're going to sell a put. So it's a bullish put spread, okay? So you're expecting the prices to go up and you want the value of the puts to go down. That's why you're getting a credit for it. So that's where it gets a little confusing. So make notes, write this down, okay? When you're expecting the stock to go up and you want to collect credit, when you want to do a credit spread, you're going to sell a put spread, okay? And then it's the opposite. If you're expecting it to go down, instead of purchasing puts, you're going to sell calls. So you're going to sell a call spread. So even though it's call, it's a bearish call spread. Okay. So for instance, you're expecting Amazon to go up in this example. So we're going to click on put. The price right now is at 152, right? 152.93. So what we're going to do is I'm going to go ahead and I will sell, click on sell, put, sell, because I'm expecting it to go up to 125. And then I want to limit my exposure because the max could be ridiculous. The max loss would be ridiculous, right? Max profit is only 125, but the max loss is $15,000. We don't want that. So to offset that and to create the spread, I'm going to go ahead and buy the next level down, which is the 150, and we're going to buy that for 48 cents, so $48. So now we've limited our downside risk. Now the stock could stay where it is. It could go up. It could fluctuate a little bit. It could even go down a little bit, right? And would still make some money on this. But if it goes up, great. And by expiration date, our max profit would be 76. Our max loss would be 174. Okay. So that's how you do a bullish put spread, which is a credit spread. So even though it says put, you're selling. That's why, but you're collecting a credit right up front. So that's a concept you have to get your mind around is, the terminology, it feels the opposite when you're collecting credit. When you're getting premium, it's the opposite, okay? So for instance, let's go ahead and do this and you're going to click continue. We're just going to do one for the example and we're selling this. So we're going to collect the least amount of premium. So I'm just going to max it out. I'm just going to go for the bid price because we're selling a put spread, right? So let's see if it gets executed at this price. It should. And if it doesn't, there we go. Come on. Come on, come on, come on. The market's about to close soon, so we want to make sure that this gets executed so I can get out of it too before the market closes. All right, well, let's just change it to even a lower price, so make sure that it does execute. So you guys see the example, 0.73. So we're just going to collect $73 in credit. There you go, executed, right? And then once that's done, and you want to get out of the trade, you're like, okay, so I sold the 152, I bought the 150 as protection, right? So when you want to close it, you're gonna buy back the 152 and you're gonna sell the 150. But instead of doing that as a instead of doing that as a separate transaction and doing both of these legs, the cool thing about Robinhood is you can come back into your debit spread, I mean your credit spread, right? This is what we did. You can just click on close. It'll execute both legs for you at the same time. So now we're gonna get out of this trade, and the way we're gonna do that is we just did one contract as the example. Let's make sure we're gonna buy it back. We're gonna buy it back at the 179 price. And it keeps going up, so it's going to keep costing me more, but it's fine. Oh, the cost of education. I get to teach you guys, this is great. All right, so I'm going to review this. I'm just going to, and boom, hopefully it should, yep, it executed, and we're out of that trade. Simple, right? And now let's see what we need to do if we feel the opposite side. If we feel Amazon's going to go down, right? If Amazon's going to go down, instead of shorting the stock or whatever it is, another option would be to buy it by put options, right? But if you're not too sure, you want some leeway right there, you would sell a bearish call credit spread. Okay, terminology again, right? So let's go out 31 days and say I feel like it's going to go down. So now I'm going to sell. So click on sell, your call, it's going to go down. So I want this value to go down, right? Because I want to keep that premium. I want to collect that juicy premium. So I'm going to sell this call. But now if Amazon just takes off, my max loss is unlimited. Okay, unlimited. You never want to be in that situation. So what you're going to do is you're going to create a spread out of this. So now I will buy the 160. Okay. So now it protects me because now my max loss would only be 297, where my max profit can be 203. Okay. If I'm expecting it to go down, right? Because when it goes down, I make money. When it goes up until this point, okay, I'm not going to take a max loss. Okay. So that's the beauty of selling these credit spreads, right? Because you're collecting premium, times on your side, because the options keep losing value as time goes on because of theta, right? Because of time decay. So this works out pretty well. So let's go ahead and do this. Let's go ahead and get our credits or max loss, max profit. We already know what those are. Click continue. I'm just going to do one option for this contract. And since we're selling it, I'm just going to pay a lower price, collect a lower price than I normally would, just so we can see this execute for you guys live here. All right, review order, submit, boom, executed, right? We are in this trade now. So we sold one bearish call spread, okay? Even though calls are usually when you expect prices to go up, but when you're selling them, that's because you're expecting prices to go down, okay? So now to be able to get out of this trade, instead of having to buy this back and sell this as a two-leg option, you can just go into your main Robinhood account, click on the trade that you just placed, or depending on when it is you want to get out, you can just click on close, and easy as that. Okay, so I'm gonna buy this back at 210. I'm just paying an extra premium just so we can see this execute. And here we are. All right, executed, and we are out of this trade. So I'm going to make some other videos that go into more detail about exactly when to use these strategies and things like that, and exactly how much collateral gets tied up compared to the premium that you're collecting. I'll go into that in a different video where that's all we're talking about. In this video, I just want to show you guys how to execute the actual trade. Okay. And again, nothing in this video is financial advice. It's all for informational purposes. Do not copy these trades because these were just examples. Okay. But I'll be making those videos. So make sure you do subscribe to my channel and hit that bell so you get notified whenever I do post new videos. And if you guys like, check out my All Access Patreon. I've got a link to it in the description below. And for full access, super cheap to get in. And I've got educational resources in there, my weekly watch lists I post on there. Even when I get in and out of trades, I post on there. So you guys get alerted on those. And there's also a live chat room too. So yeah, check out my full access Patreon, and then just hit that like button, rack this video up with likes, and I will see you guys on the next one.